When you get to retirement, you probably want to start creating an income, right? And you probably want to do this as passively as possible so that you've got time to travel the world, terrorize the grandkids, or lose yourself in a VR world. But the question is, what's the best way to go about creating a passive income? Well, you may be thinking, okay, income may be dividends, bonds, high income funds, maybe real estate investment trusts. Well, no, you'd be wrong. Hey guys, welcome back to the channel. So today we're going to be continuing our series looking at retirement planning. And we're specifically going to be looking at busting one of the biggest myths there is when it comes to passive income. Now this video is going to be helpful for you whether you're 50, 60, 90, 12 years old. It doesn't matter because the information that you're going to learn in this video is going to affect the way that you construct your portfolio at whatever age you are in life. So why does everybody get this wrong? Passive income. I mean, it's in the name, income, right? But today I'm going to be showing you why if you're looking for income, you should not be investing for income. Well, at least not in the way that you're defining it as income from dividends, property, or income funds. Now, I know this sounds really counterintuitive, but you're going to have to bear with me on this one because I'm going to show you step by step how I go about creating an income for my clients. And it's not how you think. So to start out, we're going to have to go right back to the basics. And the first thing that we're going to be looking at is dividends and why ultimately dividends are pretty much irrelevant when it comes to income. So if you held two stocks, Company A and Company B, and they were both valued at £100 a share. And then over the course of a year, these two companies make a profit, which equates to £10 a share. Now, if this happened, we would expect their stock price to go up by £10. Now, if Company B then decides to pay that £10 profit out as a dividend to you, we would expect that the stock price would also fall by the amount of the dividend. So you would be left with £100 in stock and £10 in cash from the dividend. So if you were looking to create an income, which two of these stocks do you think is going to be best for you? Well, you're probably thinking B, right? Well, what if you did have a portfolio that was entirely made up of A? How would you go about creating an income from that? Well, in reality, you're not just going to own one share. You're probably going to own lots, and you could simply sell down some of those shares to release that profit. And if you sold the right amount of shares, you could ultimately end up with the equivalent of £100 in stock and £10 in cash. So if I asked you again, which one would you choose? Well, you'd probably still say B, because unlike A, where you have to manually go in there and sell the shares, with B, the income is produced automatically. But is that actually a good thing? What if you received a £10 dividend, but you only actually wanted 8? Well, you then have to go and take that money and reinvest it. And then you also have no control over when you actually receive these dividends. And if it doesn't arrive when you need it, then you're kind of stuffed. Or even worse, what would happen if the dividend was reduced or even stopped completely? Just like what happened during the pandemic last year. Well, I hope you're starting to see that although this income is produced automatically, you're actually giving up control of a lot of the things that you need to be in control of, especially as you also need to consider the tax implications of this income. And the more control you have over what income you receive and when, the better you are able to balance your tax liabilities between different tax types, so that ultimately you end up paying less tax. So if creating an income by selling shares is more efficient than dividends, then do we really care about dividends? Well, not really. All we care about is whatever is going to produce us the best total return, because we know that we can go in and sell down whatever we need when we need it. But it's really important that we don't just then go and invest in growth stocks, because if we did, we would be constraining ourselves to only investing in a specific type of company. And if we did that, we would be decreasing the diversity of our portfolio, which would ultimately result in us getting a lower total return over the long term. But that would be exactly the same if we only focused on dividend paying stocks or equity income funds or property funds. If we did this over the long term, we would expect to see a lower return compared with a more diversified portfolio that was taking the same level of risk. So the total return is all you should care about. It's pretty much all you should ever care about. But don't get me wrong, dividends still form a very important part of that overall total return. But we would rather that dividends got rolled up, reinvested, and kept on working for us so that we could then, when we need to, go back in and either sell units or shares to release cash. I actually had a specific question about this last week. I'm investing in Vanguard Life Strategy and approaching retirement, but they don't have an income option. What should I do? So to give this some context, funds can come in two different types. Distribution funds, which will automatically pay out any dividends or income that is received from the companies which are within the fund directly to your investment account. Or they're accumulation funds, which means that all the dividends and income automatically roll up and get reinvested in the stocks that the fund is invested in. Now, Vanguard has chosen to have all of its life strategy funds and retirement target funds as accumulation funds. Now, one of the reasons why this is okay is because they realize that the most efficient way to create an income is to actually create it by going in and selling units as and when you need it. So creating an income like this has a lot of big advantages. Firstly, you're in control of how much you receive and when you receive it. You also don't have to go about reinvesting dividends if you ever have a surplus. You also get to choose exactly where you take your income from, which means that you can balance this with other income sources to make sure that you are in the most optimum tax position. So if you started receiving an income from a state pension, you've got to balance the fact that that is income that's coming in that's going to be taxed as income tax. So you might want to look at ways that you could release gains, which are going to be charged as capital gains tax, to balance that off. And ultimately, the most important thing of all of this is that this still gives you the freedom to invest in whatever you think is likely to produce you the best total return. However, there is one big downside, and that's ultimately the fact that it's not really passive, because you have to go in there and choose when to sell and what to sell. And this can be really tricky if you're investing in individual companies and you've got a portfolio of 100 different companies. You need to work out which ones are you going to sell down when. But the reality is that most people, all of my clients are invested in funds. And when you're only invested in a couple of funds, it's actually pretty simple. So the first thing that you're going to have to do is you're going to have to create a cash buffer. So this could be between 2 and 5 years worth of expenses that you are going to sell down from your portfolio, and you're going to keep it separate in some sort of savings account. Now, the exact amount that you hold in this cash buffer is going to be personal to you. And the things that you're going to need to consider is, what other income sources have you got? What is your attitude to risk? What is the risk level in your portfolio? And potentially whether you've got any debt. Obviously, the more risky position you're in, the bigger amount of cash buffer that you're probably going to want to have. And then the idea is that you then start to pay yourself an income from that cash buffer. Now, this depends on how you like to budget, but this could be weekly, it could be monthly, it could be every year if you wanted. But the idea is that it feels like you are receiving a salary, which makes things easier to budget. Now, the next part, and the important part, is how you then go about selling down your portfolio to replenish your cash buffer. Now, there are various different ways that you can go about this, but it's really important that the way that you choose is systematic and that you stick to the plan. We find that often the best time to do this is actually to do it in tandem with when you rebalance your portfolio. Now, I've talked about this several times before, that if you are invested in a couple of different funds, they are going to grow at different rates, which ultimately means that over a period of time, they're going to end up unbalanced. So every 6 months, every year, whatever you set, it's a good idea to go in and rebalance those funds by selling down some of the ones that have grown and buying back some of the ones that haven't. And as part of this, you could simply rebalance so that you also release a year's worth of income. But you've also got to consider the tax implications of this, because if you are selling something that's at a gain, you might be realizing a capital gain that you might have to pay tax on. So although this is not strictly passive and you do have to do a little bit of work every year, it's not exactly a big deal, and it comes with a whole host of advantages. So I hope this has helped you understand why the most efficient way to create an income does not actually involve investing for income. It involves investing for the best total return, which is ultimately what you're pretty much always doing, but then artificially creating an income by selling things down as and when you need to. But the question you've probably got in your minds is, what happens when the markets fall? Should you keep on selling, or do you just start eating into your cash buffer? Well, to answer that question, we're going to have to dive into a lot of data, but because I'm trying to keep these videos really short and concise, we're going to do that in a separate video. But in that video, we're also going to be looking at safe withdrawal rate. So that's how much you can sustainably withdraw from a portfolio without depleting it. And I'm also going to show you some really interesting ways that you can maximize this sustainable figure simply by making changes to the amount of income that you withdraw depending on different market conditions. But in the meantime, if you're still looking to learn, then check out this video here where I explain why I think right now is the best time to be investing.